Perhaps one of the biggest lies we've been told when paying off our debts is there's no way you could generate passive income while paying off your debts. We're actually going to show you step by step in this video how that's not true. And quite frankly, I think I've been teaching you wrong. Let's dive in. Guys, I gotta apologize right off the bat because what I've been doing is I've actually been having you focus on paying off debts instead of the more powerful focus, the more powerful target should be generating passive income. And I'm gonna share with you exactly what I mean in just a few moments. Listen, we are all familiar with this scenario, right? Whether it's a car loan, whether it's a mortgage, any loan, you have loans that you have to pay each and every month, and it doesn't matter what you do to the principal, this amount is going to stay the same each and every month, at least when it comes to loans, okay? And of course, on this side, you have the line of credit, which we're all too familiar with, the $10,000 at 21%. And I want to share with you a very powerful statement, and that is, segregating your income is the worst thing you can do when it comes to paying off debts and generating passive income. This is what I mean. Let's go ahead and take, as we draw borders, the income of $5,000, okay? Let's take the expenses of $4,000, and that will leave us with a cash flow of $1,000. Now, of course, the cash flow would equal the 5,000 minus the 4,000. What you and I are used to is we're used to placing our paychecks, right, inside of our checking account. And then we are used to dividing that income up to everyone except ourselves so that at the end of the month, we're not left with $1,000, right? We're left with a cash flow of $0. And can you see the problem there? Because what we're going to do is we're going to make sure we're using our cash flow to pay off our debts in a very fast and systematic manner. However, can we do that when we are segregating our income to the car, the credit cards, to savings accounts, and to all these other expenses? The answer would most likely be no, all right? So what we want to do is we want to share with you the 4 pillars of velocity banking, okay? First, we're going to go ahead and diagnose the drain, meaning if you have multiple loans, I need you to put them through something called the cash flow indicator. That's where you take the principal balance, divide that by the minimum monthly payment, and you're going to come up with a number, right? And it's going to go from 0 to 100, and of course it could be above. And what you're going to see are some numbers. Now the number that's closest to 0, well, I want you to count that as the most inefficient loan, and then I want you to focus on paying that one off first, okay? That's diagnosing the drain. Then what we're gonna do is we are going to redirect our cash flow. What does that mean? That means we're no longer putting it just into the checking account to get it segregated out so that we are left with a 0 cash flow. No way. What we're going to do is we're going to open up a line of credit. And of course, if you're curious about different lines of credit, maybe an all-in-one HELOC is for you. We do have the description link below. But if you're curious about lines of credit, just let us know, okay? And we can share that with you. That way, right, your income is consolidated inside of a line. Now, you've heard of consolidated loans. I'm going to introduce to you this concept. I want you to consolidate your line. Why? Because that's when that $4,000 in expenses can actually be in your control. Because now you're going to be paying your line of credit with your income, and you're paying your expenses from your line of credit. And what is left over? That $1,000. is left over to pay down this line of credit. Now, you're used to that, right? Okay, we've done all those videos on that. Well, here we're going to share with you a concept that we haven't really brought out. We actually introduced it a couple of weeks ago with the passive income generation, but now we're going to go more fully into it because I want you to know what's possible when we retarget where we're supposed to place our finances. Here we go. Now, for those of you who are curious about our new Velocity Banking Wizard that is actually helping people with their debt elimination roadmaps, I'm out of the picture. They're just putting in their income, their expenses, and their debts, and they're having a whole roadmap. Listen, that's in the description link below as well, okay? Man, look, if you're looking at the income segregation, right? We're no longer there, right? You see how it was designed as a Conestoga wagon? That actually is a symbol of where people are in their banking, okay? It's horse and buggy banking that people are still wrapped up in, right? These concepts such as velocity banking are new to them. All right. So if you have any more questions about that, or you want your own debt elimination roadmap, go ahead and get that Velocity Banking Wizard. We created it ourselves. You're not going to be able to just put the numbers into some regular AI. We created it ourselves, and it's for you down there, the description link. So now where we've come is cash flow. We're going to be focused on generating cash flow, and we're going to introduce a concept called the 50/50. What does that mean? Well, we know that you have the $10,000 here, and we know that 21% simple interest is way less than 6% amortized interest. And we're used to having this $10,000 go all the way over here, right? And deploy that $10,000 so that it can now be reduced to $190,000. Why would we want to do that? Well, because we are paying our line of credit with our income and the cash flow was $1,000 being left in there, we're going to pay off that $10,000 in about 10 months. Okay. And after that 10 months is done, what are we going to do? We've already replenished the 10,000. What are we going to do next? We're going to deploy it again to the principal. That's how people are paying off their loans in way less time. Not 30 years, not 40 years, not even 11 years, right? This one is about 7 years, if you were to do that. But I want to share with you this, okay? What if you were to take that $10,000 and instead of having this as the priority, because if you take that $200,000 and divide it by 1,200, guess what? It's on the freedom zone. Guys, it's on the freedom zone. And I know that may be a shock to you, but that's what it is, okay? But I want to share with you what's possible if instead, right, and I'm just submitting this for your consideration, instead of focusing on paying off a mortgage, what about you focus on passive income generation? Do you remember what Robert Kiyosaki said in his book, Rich Dad, Poor Dad? When your passive income exceeds your expenses, you can quit your job, right? All right. So what we want to do is we want to transform this $5,000 in earned income. We're just going to put an E right there. And we want to make sure that this $5,000 is now with a P, passive income. Because once you're doing that, all you're doing, right, if the passive income is you're sitting at home seeing what video can help other people with velocity banking. This is where your $5,000 passive income comes in. Instead of you going to work, right, to earn the income, now we've transformed that well-earned income into passive income. Okay, let's take that $10,000, all right, and instead of putting it towards the loan, okay, which you can, but I just want you to catch this vision here. I want you to take the 10K and turn that into about $200 a month in monthly income. Now, there are investments that are higher than this, folks. It is possible. Okay. Short-term amortized investments is what it's called. STAI. STAI. All right. And of course, if you have any questions on that, don't worry. Go ahead and go to tardiswealth.com. We actually have that in the description link below as well. All right. This is possible. Do you understand? And you can get this $200 each and every month. Now, of course, you are going to have to pay that $10,000 back. Nobody is saying that you don't have to pay it back. All right. It's going to take you 10 months to do that. All right. Now, after the 10 months, okay, after 10 months, what I'd like you to do, okay, let's go ahead and deploy that $10,000 again for yet another $200 each and every month. Now, remember, down here, our cash flow was $1,000. And as you're paying off the loans year after year, right, over here on the mortgage side, your car loan, remember, your cash flow is not increasing. However, because your focus has changed, now your cash flow is increasing, right? After 10 months, right? After about a year, you are now at $400 passive income, right? Now, another 10 months goes by, right? I want you to catch this now. Another 10 months goes by, right? You're going to deploy another 10,000, and that's going to equal what? 200. I'm actually lower. This is on the lower end, okay? Just being conservative, because I want you to really get this, okay? This is 10 months. After 20 months, you have $600 in extra cash flow. So now that's a total of $1,600 in cash flow. Let's take you all the way into the future and see how long it takes before you can replace your $5,000 of earned income with passive income. Let's go ahead and do that calculation now. So we went ahead and finished the calculation. And I want you to know that as you're increasing this passive income, you know what else is decreasing? The time you have to pay off that $10,000. All right, let's go ahead and get into it. We've already matched this with the 400. This is the 200. Remember, you deployed after 10 months, the $10,000 to gain that $200 each month in passive income. And then, of course, that gave us the answer of $1,600. Now, what we have to do is we have to go ahead and add this one in, okay? We didn't add this one in, so now we get to add it in. So 1,600 plus 200, okay? That's gonna equal 1,800. Now, I just wanna make sure that you're following me here, right? 400, that's where we got this number from. 200, that's where we got this number from. And then another 200, that's where we got that number from, all right? Now, of course, we are not done. And remember, we are at about 30 months right now, okay? And I gotta be honest with you, I almost got discouraged when I first did this calculation because I was like, man, that doesn't change anything, until I realized, wait a minute. The cash flow is increasing, which means the time to pay that $10,000 off is decreasing. So let's do one more. We have after the 10 months, we have another $200 each and every month. Remember, folks, this is passive income, not earned income. Okay. This is passive, meaning you can pass the day away, right? And make sure that your money is still coming in, all right? 1,800 plus 200 is 2,000. Now, what happens when your cash flow gets to 2,000 like ours? The time to pay that $10,000 off goes in half. So now we're paying $10,000 off in 5 months. 5 months instead of the 10 months, okay? Because of the $10,000, right? Divided by $2,000. That's going to equal 5 months. Now, after another 5 months, you can then deploy the $10,000 to equal the 200. Remember, you're investing in passive income. So now you're generating that $200 each and every month, right? And instead of it taking you 10 months, now it's taking you 5 months to pay that off. And it's going to get less and less time the more cash flow you gain through passive income generation. Okay, until finally you are at your mark of $5,000. Do you want to know what that is? Well, me too. Let's go ahead and see what that is. So if you do the calculation, you'll see that it'll take you about 4 years to get you to $3,000 a month in passive income using the $10,000 in lines of credit. Now remember, if this is an unsecured line of credit, it's not even your money. So you just made money off of someone else's money. That's what they mean by it. All right. And yes, you can gain principal and interest payments. It's called short-term amortized investments, and it is a thing. Okay, I want you to go ahead and make sure that you're focusing on this, right? So that the passive income can actually overwhelm your debts. This is where we need to be focusing, right? From now on, we'll be focusing on this because it's not just about paying off your debts. I remember a good friend of mine, and you know who he is. Joseph said, CJ, after you've paid off your debts, you're still at ground zero. So really the end game needs to be building your wealth. And this is how it's done. I want you to start using your lines of credit as leverage. Okay? Never cut up your leverage. You were taught wrong. All right? Please, the $10,000 in lines of credit needs to be used as leverage so that you can get $3,000 a month. Watch this, in passive income. That's where we need to focus, folks. Passive income. And if you need help with that, you need to talk to my boy Kevin. Man, he knows what he's talking about. God bless that man. All right. So look, folks, please go ahead and click in the description link below if you're interested in the passive income. Let's go ahead and do that. If you're interested in the Velocity Banking Wizard, we have that in the description below. And watch this. If you need help in anything Velocity Banking, then there's the video that you need to go to, as well as keeping in contact with me. God bless you, and you have a great day.